The classical measurements for valuation, for quality, they've degraded a lot in terms of the ability to use them for stock picking. And we got to thinking, what's happening? The implication of the research that we've applied to our portfolios is we're actually seeing price to book as more of a risk factor in our portfolio construction. For the low intangible industries, we use classical valuation methods. Classical financial statement analysis continues to be quite valid. But for the high intangibles, what we're finding is that sentiment-based analysis is more important.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Bridgeway Capital Management. Justin Carbonneau is a managing director at Life and Liberty Indexes. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Bridgeway Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Jacob Pozharny, partner at Bridgeway Capital Management, to discuss the importance of intangible assets like intellectual property, brand value, and human capital, and how assessing intangibles plays into the development of various investment strategies. We talk to Jacob about intangible intensity and explore what it means, how it's measured, and how it's influencing the way some portfolios are built at Bridgeway. We also discuss how intangibles challenge traditional value investing frameworks, the implications for global and emerging markets, and the growing role of AI in investing. As always, thank you for listening. Please enjoy this discussion with Bridgeway's Jacob Pozharny.
Jacob, thank you very much for joining us today.
Well, thank you for the invitation. I've been monitoring and listening to a lot of the stuff that you've been putting out, really enjoying it, and appreciate the interest in the research.
Yeah, thank you so much. So one of the things that I think has come to light in really the past decade, although it's been happening for a lot longer than that, is the increased importance of intangible assets in terms of company valuations and economic growth. And so what we wanted to do with you today, based on a lot of the research that you've put out and based on some of the investment strategies that you run, is talk about how you look at intangible assets and get at this idea of intangible intensity and trying to understand what it is, how it's measured, how you utilize that in your investment process and in building equity portfolios at Bridgeway. So I think this will be a really good discussion and something that our audience has to some extent heard us talk about in the past, but you've done a lot of really interesting research on this topic. So maybe for us to start, for those people that maybe have heard of intangible assets but might not know exactly what they are on a company's balance sheet, can you just kind of walk us through what they are and I guess their importance?
Sure. So intangible assets are just like company assets, but they're assets that are difficult to measure, but very important in explaining the market value of a company. So companies develop intangible assets to enhance their operational efficiency, to reduce costs, to drive their revenue growth. But these investments actually decrease the net income, and they have a tendency to negatively impact book value, although they're designed to be additive to growth. So this naturally complicates classical valuation metrics, classical quality metrics, and a lot of the stock screens that folks are used to using. So new economy industries, knowledge-based industries are much more impacted by the growth of intangibles compared to old economy industries. Like examples of intangibles would be intellectual property, proprietary algorithms, like Google's PageRank algorithm is an example of an intangible asset. It's something that's very useful, very productive, but it's hard to value. TikTok's For You recommendation engine is a proprietary algorithm. Very hard to value, very important to the business. Brand equity is another example of an intangible asset. Think Coca-Cola, Nike, Disney. Customer relationships are another element of intangible assets. Think of the relationship between the client and Amazon, the client, and Costco. These are material things, but they're very hard to value in order to get at explaining the market value. Interestingly, a lot of the introductory textbooks, when you first start learning about accounting, they actually attribute a lot of the difference between book value and market value in terms of intangible assets. So they're a critical element in understanding valuations.
That is an excellent overview. Thank you very much. I think that that's perfect. And as you know, your examples were spot on. And when you start actually discussing it, you can see how in sort of the world we live in, how a lot of really successful businesses, can have these intangible assets that are, key to how they might be valued by investors in the market. What is the idea behind intangible intensity?
Yeah. So what motivated our research in intangible intensity is recognizing at around 2016, 2017, that the classical stock screens, the classical measurements for valuation, for quality, they've degraded a lot in terms of the ability to use them for stock picking. And we got to thinking, what's happening? And then as we're researching this, we recognize that a lot of really smart people have been doing really good work on this. I came across back then a book by Baruch Leib titled End of Accounting that was very influential in my thinking. Our research on intangible capital intensity expands on a couple of the chapters that he presented in that book. So why don't I define how we look at intangible capital intensity, and then I could tell you how we use it. So the challenge in defining intangible capital intensity is that a lot of this stuff isn't really reported. IFRS accounting, US GAAP accounting doesn't require intangible assets to actually be reported. There's certain elements that we used in our research to help us guide where intangible assets are. So there are three elements in our research that we focused on. The reason we focused on these items is that they were available in the balance sheet, they were available in income statement, and what we tried to do is extend our research into international and emerging economies. And all of these elements, these three elements, were actually available for our analysis and computing the intangible capital intensity metric. So we focused on three items, as I mentioned. One is capitalized intangible asset, that excluding goodwill, and I can get into why we excluded goodwill a bit later. The second is innovation capital, which is proxied by R&D expenses. And the third is organizational capital. And this is proxied by selling, general, and administrative expenses, SG&A expenses. So these three items actually available in the balance sheet, they're available in the income statement, and we were able to pull this for a fairly substantial universe of about 15 countries, US, developed economies, as well as emerging markets. So we created a measurement based on this. We looked at the average value of companies and industries of each of these measurements. We ranked these on a month-end basis. And then we looked at the average ranking, and that naturally tended to differentiate certain industries. And that differentiation was very consistent over time. I think we did this research from 1994 to 2018 in terms of data, and that categorization appeared very consistent, very robust. So that was the primary way we identified intangible capital intensity, by the ranking, and then we grouped them into highest to lowest intangible capital intensity by industry.
Is it a ratio? Is it a ratio, or is it how do you actually rank?
Sure. So in terms of the definition of capitalized intangible assets, that is measured relative to total assets. R&D expenses are measured relative to total revenue. SG&A expenses are also relative to total revenue. So for every industry, we looked at the monthly averages, and then we ranked those monthly averages for each industry, and then we did an average of those rankings, and we charted that through time to naturally categorize industries into high intangible intense industries and low intangible intense industries.
When you look at intangible intensity across the whole economy, I assume it's been an upward line, right? It's been moving up over time.
It certainly has increased, and it's interesting how different aspects of these measurements have increased. So with the capitalized intangible intensity, from 1994 to 2018, that measurement as a proportion of assets actually doubled. So it was a substantial increase. Obviously, this varies from country to country, industry to industry, talking about generalities. R&D expenses also increased quite substantially. They increased by 50% on average from 1994 to 2018 as a proportion of total revenue. SG&A expenses actually remained quite stable. Obviously, variations existed from industry and from across countries, but that's an element that actually remained quite stable over our research period.
How much of this is a technology thing, and how much of this is intangible intensity has actually been increasing in other industries where people might not think it has been?
We're seeing this consistently increasing across most of the knowledge-based industries. So it's not just technology. It's you have software, you have biotech. There is substantial increases in terms of financials. The technology, the algorithms that are being used there were quite influential. So it's not just in the technology space. It's across different industries. We actually put together a table of different industries ranked by intangible capital intensity from highest to lowest. So pharma, software, telecom were some of the highest. Semiconductors, obviously, another one. But it's not just technology. It's anything that's new economy that's knowledge based.
And do you find that high intangible intensity companies have higher profitability metrics, like higher return on equity or higher earnings growth or things like that?
We find that the measurements of ROE, the measurements of book value, the measurements of earnings are very unstable. And what's most important, and we put out this paper in Financial Analyst Journal, I probably should, very important to mention that this is a collaboration between myself, Amitabh Dugar, and Andrew Birkin. We put this research together in this publication. And what we find is that the explanatory power of fundamentals in terms of price action hasn't really been affected for the low intangible industries. So for the low intangible industries, fundamentals continue to explain price action quite well. But for the high intangible industries, we find that fundamentals, quality measurements, valuation measurements are affected, and they have a much lower explanatory power in terms of explaining future price action.
That's actually what I was going to get into next, because I was going to ask you about the price to book. And one of the things I've always struggled with the price to book is obviously, Microsoft or Google's price to book may not be that meaningful, but at the bottom of the barrel, it seems like price to book would be more meaningful. So I was thinking like a straight standard price to book strategy might not be that affected by intangibles. Is that right?
We see book value as a very noisy measurement. As a matter of fact, the implication of the research that we've applied to our portfolios is we're actually seeing price to book as more of a risk factor in our portfolio construction rather than an alpha factor. So it's changed our thinking quite dramatically in terms of how we actually build out the portfolios.
How does that change things when you look at it as a risk factor versus an alpha factor?
You are able to still tilt on value, but you're not necessarily tilting on value based on book. It actually improves the consistency of the risk-adjusted returns when you do that, because we see that price to book is a bit more of a risk element. I wouldn't say this is true prior to perhaps 2007, but after 2007, it's overwhelmingly true, and it's consistent with the type of growth we've seen in intangibles that we've observed in this publication.
So when you look at valuation, do you need two strategies? So do you need to look at the high intangible companies with one set of metrics and the low intangible companies with a different set of metrics?
That's actually exactly how we started thinking about this. So a lot of our competitors, and we've explored this to a great deal, they make adjustments to different measurements of intangibles, and we certainly do make these types of adjustments on an industry by industry basis. But I think what we do a bit differently is we use completely different gearing for our stock selection for high intangible and low intangible stocks. And this is applied across our global strategies, across developed markets and across emerging markets.
Can you talk about how that might work in the real world? Like for your traditional value companies, you might use maybe a composite of value metrics. And then for the high intangible companies, you might use something totally different. Can you talk about, I mean, I don't want you to give away your secrets, but can you talk about some, like the different types of metrics you might use across the spectrum?
For sure. So most of our stock selection processes will vary quite significantly from one industry to another. But in general terms, for the low intangible industries, we use classical valuation methods. Classical financial statement analysis continues to be quite valid. But for the high intangibles, what we're finding is that sentiment-based analysis is more important. So we have very specific ways that we define sentiment internally. But in very general terms, we tend to prefer to look at growth of the fundamentals, forecasts of the fundamentals, revisions to the fundamentals. We find that's much more important in understanding how to price stocks in the high intangible industries. The key here in using sentiment-based analysis is to make sure that when you're using sentiment-based analysis, you are looking at information that isn't priced in. And we have another set of processes to understand what sentiment is priced in to the stock and what sentiment is not priced into the stock. So naturally, the opportunities are in sentiment that isn't priced in.
Yeah, that's really interesting. So do you couple that at all with valuation on the high intangible stocks, or have you found valuation is not that useful there?
I continue to be a strong believer in value and quality metrics. This isn't an issue for the high intangible stocks that we just throw out valuation methods. We don't do that. We just emphasize sentiment-based analysis. In aggregate, when we combine our stock selection to low intangibles and high intangibles, the portfolio in aggregate becomes fairly balanced. But we're across all industries. There are different metrics of valuations and quality that we do look at.
And do you think about like each one of these having a certain portion of your portfolio? So do you think we want to have a certain number of high intangible companies and we want to have a certain number of low intangible companies? Is that the way you think about it?
Obviously, the high intangible and low intangible industry weighting changes based on investment universe. We see stock selection and portfolio construction as two different elements. At the portfolio construction level, we want to make sure that we are building out a well-balanced portfolio. I think an element that differentiates our return stream is that because we have very different gearing for high intangible and low intangible, when we put it together in an aggregate portfolio, there are different things, different animals that are working with each other and against each other. So it's important to combine them in a fairly uniform way to develop consistency across alpha signals that we believe add value to the portfolio over time.
I'm curious, when you look at intangible intensity internationally, has it grown less? I mean, I would guess based on just what I think, like with more technology companies in the US, it would have grown more here, but is that true?
We actually found intangible intensity to grow more for international companies compared to the US. I was a bit surprised by this result, but I think it's all about where you start, right? I mean, if you're starting at a higher level, you would expect a bit less growth. If you're starting from a lower level, you would expect a bit higher growth. But that was a bit of a surprising result for us.
Was that because did you adjust for industry? So in other words, did you account for the fact that the US has more technology, so it should have more intangible growth, and that's maybe like Europe is, or international companies have grown more on an intra-industry basis?
This isn't in the paper, but we naturally looked at this as part of our analysis. So we did adjust for it. Even after the adjustment, we can still make this type of observation.
Well, I want to take this forward, and how AI is something everybody's talking about right now. It's in the news. Everybody's thinking about what it's going to mean for our lives, what it's going to mean for investing, for all kinds of different things. How do you think about that AI when you think about intangibles? Like it would seem like intangibles are going to be going up much, much more here in a world of AI. Do you think that's the case?
This is a big topic. Needed to get a drink.
We can spend the rest of the time on this, right?
Okay, so it's a really good question. I've been thinking about this a lot. The accounting framework, it fails to capture the true value of AI-related assets, and we've been thinking about this on an industry-by-industry basis. So in industrials, for example, AI optimizes manufacturing, supply chains, but these intangibles like patents and different types of algorithms, training programs, it complicate profitability metrics because it's very hard to assess the value of these AI-related assets. In the media space, AI enhances content personalization, it enhances ad placement ability, but again, how do you value the firm's ability to value these AI-related expenses, AI-related assets? It's really tough to do. In the software space, there's heavy R&D investments that are AI-driven. It distorts short-term profits with the objective of growing long-term growth. So we definitely see it as particularly important to look at right now. In the finance space, AI improves fraud detection, risk management, but these proprietary algorithms are very difficult to value. So we definitely see it as something that's particularly important to look at as the AI expenses increase and they can materially impact the profitability of firms that look at.
Yeah, to your point, like the Mag 7 firms are spending outrageous amounts of money right now on AI. And it's like, you would think about, how do I value that in terms of the intangible asset they're creating? That seems like there could be a very wide range there. And that's a very difficult thing to figure out, particularly with a new technology that we are really seeing for the first time.
Absolutely. I think that a lot of the value of intangibles, especially for the technology firms, explain a lot of the difference between market value and book value. You see huge appreciations of market value. They look much more expensive based on earnings, but these AI expenses are actually negative to net income. Naturally, that distorts the PE ratios of these companies. So I think this is another motivation for us to have a contextual stock selection process and have different gearing in our stock selection for high intangible and low intangible stocks.
Yeah, to some extent, this relates back to the tangible world, because when a company makes a tangible investment, sometimes those work out exceptionally well, sometimes those work out exceptionally poorly. And it's the same thing in the intangible world, right? Like, I mean, we don't know. It's hard, just because somebody makes an investment, you don't know how it's going to work out. So it can be challenging.
Absolutely. That's why we spend a lot more time focused on sentiment analysis for the high intangible stocks. We actually noticed that because of that, the portfolios are much more nimble. They have higher turnover expectations for the high intangible industries compared to the low intangible industries, because sentiment is something that is much faster moving. The information is much more dynamic.
You may not have looked at this yet, but do you think in the future we might use AI itself to try to value the intangible assets? So in other words, not starting from investments on, income statements or balance sheets or anything like that, but maybe starting from, like, in the real world, could we use AI to figure out what someone's brand's worth or someone's intellectual property or something like that?
Yeah, that's a great question. So in our current process, we're not using machine learning or AI for stock selection. We are using machine learning for risk modeling. So we can talk about that a bit later. We're not ready to use AI and machine learning for actual stock selection. This is an area of research for us. NLP techniques, natural language processing, textual processing, the Q&A that you hear on quarterly calls, I think it does give you a lot of information of what companies are doing in terms of AI that can be used in terms of stock selection. Again, this is an area of research. This is actually a big focus for us in 2025 and a bit in 2024.
Yeah, it's an interesting time, and we're quants too. It's an interesting time to be a quant right now because we have all these tools available to us, but by the same token, we want to rely on what we know has worked over time. Like if we believe that a factor should have an explanation for it to work, then, and some people believe that now and some people don't, but if we believe that, then we want to start with that as a core, and we don't want to go crazy with AI developing things, but by the same token, it's also a technology that's going to make us better at what we do. So there's an interesting balance there, I think.
Yeah, I think a big challenge here, Jack, is that we all know about ChatGPT, we all know about LLMs. My biggest concern in applying that type of technology is that there's an element of a look ahead bias. So when you're looking at trying to assess what your simulation would have done in 2020, and you're using an LLM that's fitted in 2024, that LLM knows what happened in 2020, 2021, 2022. So how do you really trust what it is that it's telling you? I think there needs to be a specific accounting taxonomy in applying NLP techniques. And this is something we've been thinking about a lot, and I'm sure a lot of quants have been.
It's a really interesting question, and one I've been thinking about too, because in theory, these things know everything historically. We've been taught there's a certain way we test things. We test things, out of sample, and we do all this other stuff. But I wonder, do these things negate that because they know everything? It's not like you can go back and create an LLM and say, only know what you would have known in 2014 or something like that, or in 1972 or anything like that. So it's an interesting balance, how to use these things and couple it with the way we've tested things historically, I think.
Yes, I think it's going to be one of the most interesting challenges for quants in the next decade. It's a very exciting area of research.
So I want to talk about this. You actually have used this research in long-short investing in a fund you guys run. And I want to talk a little bit about that because that seems like a very interesting context to use this intangible research on a long-short basis. So can you just talk a little bit about how you've done that?
Sure. I'm not going to... compliance has warned me that I can't talk about any funds that we have, but what I can talk about is our absolute return platform, what it is we're doing in general. But before getting into the details of the stock selection, maybe I can just talk about a bit what that is for us. What does an absolute return strategy mean for us? So what we've done with our absolute return strategy portfolios is that we try to build a return stream that is agnostic to market direction. A lot of folks call this a market neutral strategy. I'm very wary of calling strategies like these market neutral because even when you build a strategy that has a zero beta, it is zero beta going backwards. It's not zero beta going forwards. Beta isn't necessarily predictive going forwards. So I like to think of our return streams as agnostic to overall market direction. Our strategies have equal amounts of longs and shorts. They typically, at the time of rebalance, are net zero, gross 200%, so 100 longs by 100 shorts. I think where we might be different from other folks is that our gross exposure is proportional to our stock selection efficacy. So we're finding a lot more opportunities in small caps and mid caps. We're finding a lot of opportunity in terms of stock selection efficacy outside of the US and emerging economies. So our gross exposure is proportional to that opportunity. So in our global strategy, we can have as little as 15% of our gross exposure in the US. It varies based on opportunity. But what we're trying to do is we're trying to tie gross exposure to our overall stock selection opportunity. We're targeting about a 10% annualized volatility over a market cycle. That seems to be a marketable strategy. What we typically do in our strategies is we invest in a very diversified way. We're invested in 35 different countries, 11 different sectors, typically all sectors. So 250 to 300 longs versus about 300 to 350 shorts. We're doing this with single security positions. So we're applying our stock selection quite directly. We're taking our research based on intangible capital intensity, and we build out a contextual stock selection process. We emphasize fundamentals for the low intangible industries. We're emphasizing sentiment for the high intangibles. And each industry has different measurements of what we categorize as value, quality, sentiment, and trend. We're trying to emphasize a return source that's idiosyncratic in nature, and we're trying to cap systematic exposures in the portfolio. What's interesting for us is that we have, I would say, 85% of our process to be somewhat systematic. 15% is discretionary. So we constantly are looking at the assumptions that our models have. And whenever there's an assumption failure, whenever there's an externality to the process, we tend to mute our stock selection preferences. So we grade our stocks into A through F categories. And if we have an A category and there's an externality, we will mute that A, grade it as a C, and most likely you won't get into either the long and short portfolio.
Can you think of a specific example where that may have happened, that externality came in and you guys as a team sort of had to say, we're sort of moving away from systematic and layering in a discretionary decision here? Does anything come to mind?
Sure. It happens all the time. I would say that more than half of the time of portfolio management time is actually devoted to studying externalities to the process. Meme stocks are an example of that. For meme stocks, fundamentals are almost irrelevant. Whenever there's M&A activity, the earnings of the company that is buying and being bought, it becomes totally unpredictable. It's not predictive what's going to happen with earnings, what's going to happen to cash flow in the following year or two. So we tend to mute meme stocks. We tend to mute anything that's going through M&A activity. There's government regulations. Government regulations, like the Brazilian government loves to cap the amount different utilities can charge. Obviously, that has an effect on earnings. Whenever there's government regulation, we really question the underlying assumptions of our investment process. So there's lots of examples. Just working through one this morning.
Where do you think, because you got at the issue of systematic strategies versus discretionary strategies, like where do you think human beings can be better than computers? So where do you think are the areas where, because you're a quant like me, so you probably believe in most cases systematic strategies are better, but what are the areas where you think maybe a human being is still better?
Systematic process. Every systematic process has underlying assumptions. The human needs to understand what those assumptions are and question the stock selection preferences. Do the assumptions hold of the model? You know what those assumptions are because you built the model. So it's absolutely critical, in my opinion, to apply quantitative strategy effectively, to constantly keep in mind what the assumptions of your models are, and make sure you throw out the stock picks that fail when assumptions fail.
Yeah, it's interesting. I don't know if you'll agree with this, but one of the things I always tell potential investors is there's no such thing as a purely quantitative strategy. Because at the end of the day, there's a person who created that strategy. There's a person who's deciding whether to change that strategy. Ultimately, you can't completely get human decision-making and human emotion out of this process.
Yeah, I don't like to change strategies very often. It would be unusual for me to reevaluate an entire strategy more than once every couple of years. That would be very unusual. Where the team is really focused on is making sure they understand when the model assumptions fail. This is particularly important when you're running a long-short strategy because the return asymmetry between longs and shorts, it's quite substantial. We're very careful, especially looking at the assumptions of the stock picks on the short side, because the potential loss from shorts could be quite sizable. So we're constantly evaluating it. Less concerned about model assumption failures on the long side than I am on the short side.
You mentioned gross exposure before, and just for people who aren't familiar with it, can you define what gross and net exposure are?
Sure. So for folks that are into just long-only investments, they're familiar with the notion of active share. Active share is the sum of the exposures, the overweights and the underweights. Some people divide it by two, some people don't. Gross exposure is basically the same thing as active exposure, except for a long-short strategy. The exposure on the long side is the stock value as a percent of total portfolio. On the short side, it's the short value. So if you sum up all the long and short value, that gives you gross exposure as a percent of total assets.
I want to ask about some of the unique things about running a long short strategy. I've never run one, and I think there's probably a lot of things. I mean, you mentioned some of your shorts can run away from you. That's a concern. I would think you'd have to think about, like, what's my factor exposure in the longs versus the shorts, so I don't end up being completely long value and completely short growth or something, because that could go against me. Like, what are some of the things you think about that are unique to long short strategies?
Yeah, that's actually a really interesting question. My opinion is that long short strategies allow you to mitigate systematic exposures much more effectively. With a long only strategy, the underweights you take on are limited by your index. The underweights relative to the index obviously are limited by the index value. In a long short strategy, you don't have that type of restriction. So we're able to mitigate country exposures by making sure that the net exposures across countries is around zero. We don't like taking large sector exposures. So we mitigate that type of systematic risk by making sure the sum of our longs and sum of our shorts in each of the sectors is roughly equal. We don't like to have size exposure. We don't like to have beta exposure. And it's fairly straightforward in a long-short strategy to mitigate those types of systematic exposures. As I mentioned, based on the intangible intensity research, we're actually seeing price to book as a risk element. So we tend to not take large price to book exposures, and we control that with our long portfolio, matching our short portfolio on a quintile basis for price to book. That said, we're able to emphasize the alpha signals as represented by our longs and our shorts.
Are there any other unique risks you have to think about with a long short strategy? I mean, I know as a whole, a long short strategy is certainly less risky than a long only strategy, but are there any other unique considerations or risks that people should think about when they think about a long short strategy?
I think the advantage of a long short strategy is that you can mitigate systematic exposures quite well. As I mentioned, we don't use machine learning for the alpha build, but we do use machine learning for our risk modeling. So with our risk modeling, what we also tend to do is identify systematic drivers. So what we tend to do is we look at higher frequency data elements, higher frequency prices, and we're based on how global prices move across the 35 countries that we invest in. On a daily basis, we're able to pick up latent risks using, we have our own version of this, but the classical quant technique is using singular value decomposition to identify eigenvectors that are drivers of overall systematic risks. We have our own flavor of this, but what it allows us to do is identify latent risks in the process. It's particularly useful in our long short strategies because we're able to pick up more fluid, less known risks. So classical risk models aren't necessarily going to be able to pick up geopolitical risks or risks to stocks coming from tariffs that could be in place. But as soon as there's, for example, activity that's geopolitical in nature between Taiwan and China, there's certain stocks that are tied to trade between China and Taiwan that light up as red in our latent risk models. We dig in. We have to identify how to interpret that data, but it's typically tied to lots of news coming out on geopolitical tensions between Taiwan and China, for example. As Trump won, and there was a recognition that tariffs most likely are going to be in place that are much higher than they are now. There's certain stocks that are trade related that started blinking red based on our machine learned risk model. So we are identifying these types of systematic risks. We're trying to understand those systematic risks. And at the portfolio construction level, we're trying to mitigate these latent systematic risks using our risk model. So it's particularly valuable to do that, especially when you're dealing with long-short strategies.
So before you joined Bridgeway in 2018, you spent what looks like maybe 20 years approximately focused on international equities and international strategies. And I'm just curious, sort of at a high level, like, because we know that the US just pretty much since the financial crisis has been like almost one of the best markets you could have invested in. And I think international exposure in general, probably across most US investor portfolios and maybe even institutions is probably certainly lower than it was, let's say, pre-financial crisis. So I'm just wondering, like, do you have any opinion on the importance of international diversification, whether and maybe in addition to that, like how you kind of view developed versus EM and sort of where those should be, you know, in investors' portfolios, just to help with overall dirt. And you know, to add on to that, we asked this question to a lot of guests, and then some people say, well, just buy the S&P 500, 40% of the revenues come from outside the US. Others say, no, you know, you want to be in some of these international markets for the diversification benefits that, you know, they bring to the table.
You know, that's a very interesting question. Obviously, I've been asked this question before. I have no idea if U.S. is going to outperform international or not. What I know is right now, the U.S. is about 60% of the market value globally across developed and emerging economies. And the U.S. produces about a third of total revenue of companies in MSCI, ACWI, IMI, for example. So, I mean, my question is how much more growth, how much more outperformance can you expect from the U.S. Relative to international with that type of revenue market value disparity? In terms of what excites me about investing outside of the U.S., for me, and it's really an expression of our long-short strategy, for me, what's interesting is the opportunity for investing in markets that are less efficient in the United States present a lot more stock selection opportunity. For example, in the US, I think most quants agree the stock selection opportunity in small caps is far greater than it is in mega cap names. Information is just much more faster moving in the larger names. It doesn't give you an opportunity to really make money based on your alpha. International, that gets even more. Emerging markets, the stock selection opportunities is even greater. So I had a choice of what type of strategy I wanted to run. We do have a long-only international strategy, and my choice was to actually focus on emerging market small caps. Why is that for a long-only strategy? Because I see the greatest alpha opportunity to exist in the least efficient markets. So what we've done with our long-short strategy is recognize that we don't want to play the game of predicting what's going to outperform the U.S. or international. What we've done is we've structured our gross exposure to be proportional to the stock selection opportunity. So we're seeing a lot more opportunity in stock selection in the small cap space. So our gross exposure is much more proportional to small caps. We have substantially more small caps and mid caps in our gross exposure than large caps because they're less efficient. For that matter, we have investments internationally in developed markets and emerging markets that are quite significant because we see stock selection opportunities. The opportunity to make money between our longs and shorts is much greater in places where markets are less efficient. that's why we've created this absolute return platform.
Do you do any currency hedging at all within that?
Because we are typically more or less country neutral, we don't take on too much currency exposure. In our long-only strategies, my preference is not to hedge out currencies. Hedging out currencies are very expensive things to do. And I think that if an investor really wants to diversify, they want to diversify into currencies and into international equities. So my preference is not to hedge currencies, but that's just my opinion.
Yeah, I remember at one point we were sub-advising mutual funds in Canada. And Jack, correct me if I misspeak here, but during the financial crisis, because the dollar was so strong and the Canadian bank was holding US stocks, like our strategy actually did very well, like relatively speaking, because the dollar helped prop up.
Yeah, so basically you're right. The dollar, like for those types of strategies, was a huge boost in 2008, but it was a huge headwind in 2009. So effectively, like the returns of that type of strategy, you had significantly less losses in 2008, but you had significantly less gains in 2009 because the dollar went one way on you and then went the other way.
Let me ask you, do you think, are there like emerging data sets that that you see out there that might be potentially undermined or untapped? Or, I mean, is there anything that you guys are looking at, without giving away too much of like your research and development, but that you think could be interesting? I mean, you mentioned some of the text-based analysis. I mean, we've had people on the podcast that do machine learning and things like that on patents and applications and human capital and stuff. But I'm just curious, is there anything that sort of gets you excited about alternative data sets in here?
Yeah. So we continue to extend our research and our machine learning risk modeling techniques. I'm not comfortable making that a stock selection model quite yet, but that's an area of research for us that it is really proven out in terms of improving the consistency of our portfolios. I think what's surprising me in terms of the little attention that it gets is prime brokers have a massive short availability data set. It's daily. It tells you what the availability is across every stock in the investable universe. It tells you what the price of shorting a particular stock is. I've been really surprised by the lack of academic research in this area. I've spent a lot of time studying this. I want to put something out, but prime brokers are very guarded of their short availability data sets. So I think that might explain why there isn't as more publications in that space. But that's an area that is very valuable to look at. And the classical things that you would expect to look at in that data set, they don't pan out. So you have to get pretty creative you have to get into the mindset of the shorter, the person who does take on the shorts to understand how to use that data set effectively. I'm not going to get into specific metrics that I think are interesting, but I think it's a data set that's very interesting. In terms of, I think the future of improving stock selection models is in natural language processing. I think it's in textual analysis. I think the biggest challenge to quants is trying to figure out how to do that without using too much data mining, without using look-ahead bias, without using open source LLM models in the classical way. So that's an area of research that I'm very excited about. I'm getting into that in a big way in the coming months.
You talked about the more advanced short data. Have you found, like the standard reported short interest data, is that something over your career you've found any value in? I haven't done a lot of work with that, but I've always wondered if there's value in that in any way.
Every data piece I look at is valuable. I'm not sure I would rank that as particularly high. It's just the data set is distributed in a fairly funky way. So whenever you have funky distributions in data sets, it's hard to create alpha out of them. What I'm talking about is getting to the prime broker, getting them to share that short availability data. the hedge funds out there that have access to that have an edge over the long-only investors who don't have access to that data set. And that's something that I would encourage getting creative with.
I'm just curious, like, what your day looks like, because one of the things that has kind of struck me in this conversation is I feel like there's a lot of like deep thinking happening at the firm and a lot of like conversation around these types of topics and investigating these things. And so, if you were to kind of break out like your week in terms of like what percentage of time is spent like research and development versus like actual implementation versus, whatever, other meetings, how would you just sort of, because I think for anyone that is listening to this that wants to, maybe pursue investment management, I think this is how you're going to respond. And obviously all firms are different. Bridgeway has a certain culture and that's different than the other firm down the street. But anyway, so do you get what I'm asking?
I do. My preference in hiring is not to pigeonhole people into different types of operational tasks or research tasks. My preference in hiring is to have portfolio managers have the capability of doing data analysis, financial research, as well as implementing the research and being accountable for the research that they implement in portfolios. So I'm always looking to bring on people who can do their own data analytics, who are able to read academic literature, and who are able to apply that in a portfolio construction framework. In terms of my time is much more focused on overseeing how portfolios are implemented and focused on research and development of new ideas. But as somebody comes into the firm, their focus is much more in terms of understanding the data. It's something that I had to do decades ago when I got into the industry. It was very important for me to understand the complexities, especially with international data. Understanding how to process that, understanding the financial literature. This is something that at the beginning of my career, I spent a lot of time with. And this is something that I encourage folks when we bring them on to focus on as they develop their research and development techniques, as they develop their optimization techniques, as they develop their portfolio management know-how. So for the more junior people, there's a lot more hands-on work with the data. And for the more senior people, there's more of idea generation and literature review, and just making sure that the discussions that we have on a weekly basis are informative and productive.
This has been great, Jacob. Really appreciate it. We'd like to ask our guests one standard closing question, and that is, based on your experience in the market, if you could teach your average investor one lesson, what would that be?
I would say it's to stay humble. I think that investors forget often that when they trade with somebody on the other side who may have substantially more information and substantially more skills than they do. Whenever I trade, I assume that the counterparty has more information than I do and is smarter than I am. So I want to make sure that the trade makes a lot of sense. And in terms of staying humble, for quants, I think it's important to always question the assumptions of the models that they use. Because if you're blindly following your stock screen without understanding the assumptions of that stock screen, I think you can get into some hot water.
That's great. Thank you very much, Jacob. We very much appreciate it.
Well, thank you for the interest in the research. Really appreciated the conversation.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.